Welcome everybody. My name is Alex Duvidari, and in this video I will explain to you how the Forex brokerage industry operates. And it's extremely important for you to understand that so that you can protect yourself from losing money, getting into it for the wrong reasons, not understanding who makes money how, and if that someone or that structure is on your side or against you trying to take your money. It's extremely crucial that you understand these details. I'm not saying it's inherently bad, but there are a number of easy schemes that take money from people every single day. And you need to protect yourself understanding that so that you can focus on what you actually want to do, which is trading, right? So it's important that you understand who is on your side and who isn't. So without further ado, let's get started. So in the middle of this whole thing is the broker, right? So let's write this down here. Broker. So, you know, like there's tons of them out there. I'm not going to name any names now. They're more or less all the same. Some are bigger, some are smaller, obviously. Some are regulated, some have offshore entities. I'll explain all of that in a second. So a broker is essentially where you open your trading account, where you send your money to, and where you actually trade. So it is essentially the centerpiece of your trading operation. If you're working with a broker that is shady or has any sort of issues, then chances are you cannot withdraw your money, your trades will not be executed correctly, and all of these things. So that's why, look, trading profitably is already quite challenging. Now, if you don't understand the brokerage industry at all, then you will face challenges on the brokerage side of things that have nothing to do with your trading strategy. So it adds another level of complexity that you need to have awareness of and skills about so that it doesn't hurt you, okay? So brokerages, essentially, they take liquidity from liquidity providers. So let's also do that here. So let's just say, and liquidity providers are like, it could be banks, it could be prime of primes. I'm not going to go that deep, but anyway, so these liquidity providers, let's just pick here. We call this LP, and the broker may have multiple of them, but let's do it this way. Maybe do it a little smaller. So what happens is that the LP provides liquidity to the broker, and what the broker does, the broker sends the customer's trades to the liquidity provider. Does he? Well, that's what we were going to talk about as well. Liquidity provider essentially execute the trades on the real market. So let's put also here market. Maybe put it up here. Market. And the liquidity provider typically sends the execution then to the market. Now, that's not the real truth, or that's not what's actually completely happening. Let's also do that here. So this is trader or client, and you basically deposit your money to the broker, and you also send your trades, obviously, right? You trade with the broker. Now, what happens exactly? Your trades that you send to the broker, or that you trade with the broker, basically, they don't always go to the liquidity provider. What the broker will do is what is called, maybe I'll put it up here, he will internalize your trades. Internalize. What it means is that, wait, let me make this a little bigger. What it means is that the broker will not send all customer trades to the liquidity provider. In fact, most brokers keep most of the trades of their customers inside their own operation. That means you're not really trading with the market. You're trading with the broker. Now, the broker obviously, which means if you make money, the broker loses money. If you lose money, the broker makes money. So there is, in that perspective, a bit of a conflict of interest going on, right? When you lose, he wins. When you win, he loses. And when you hear that like that, you may say like, wow, how is that possible? There are also some good sides to that, which I will also explain, but it's important that you understand, first of all, that structure. Now, the broker, you must think of, let me do this here also, shape. You have multiple traders, right? Like trader 2, and another shape, trader 3, just to give you an example. And what happens is that this trader might be, take simple example, euro dollar. This trader might be long one lot, this trader might be short one lot. So essentially the broker has zero exposure. One lot would equalize each other, right? Long, short. And now trader 3 is 2 lots long. So essentially the broker has a risk of 2 lots long. Now if the market goes down, the broker will make that money, but if the market goes up, that broker will owe this one money. So essentially what the broker is doing is it nets all the exposure of their customers, right? So, and it has tons of customers, and some are long, some are short. So the real risk the broker has is not every individual position or exposure of every individual client and account, but the totality of them, the net of them, basically. And that's how brokers manage their risk. So they may choose, they have like their own risk models of how they will manage that risk. At some point, they will then hedge themselves. Hedging means if they have an own exposure, after all customers, the net position is, let's just say, 10 lots long, then they will also trade that position with the real market. So if that position wins, the market P&L would actually make that money for the broker so they could pay their customers. Now, especially in the beginning of the Forex industry, and I've been there from the very first day, many brokers were operating a pure B-book model. Internalizing means B-book. B-book means like I keep the trades in-house or warehousing, or there's so many words for that. And when the customers lose, everything's good. But sometimes customers win, and then if the broker has not managed their risk, they will not have the money to pay the customer. And I've seen countless brokers actually go bust, go broke, not being able to pay the customers. So that's why it's always important to deal with a brand of broker that's been around for a long time, ideally, and also is regulated in a really strong regulation. And yeah, because they are more heavily checked for these things. And also, you know, the reputation over many years shows whether the broker has solvency and also, like, let's just say, is operationally so professional that they can manage and handle everything. So that's on that side. Now, what also you need to understand, why does the broker keep the trades in-house? Because every trader pays spread. Every trader pays commission. And if the broker, just the difference between the cost of every trader has individually and what the broker actually has to hedge with the LP in the market will make the broker money. And then this is how they manage their money. So the difference between what the broker has in execution cost and the difference of what the customers are paying for their execution cost, that is already making the broker money. So that's why brokers do that. This is their model. Now there's some brokers that also offer a book execution. So a book means that every trade of the customers goes immediately to the LP into the market. The downside of that is that it's more expensive, so the broker will make less money. It has less risk for the broker because basically it has no risk of a B book or something like that. It's called an agency model. They hedge 1 to 1 to 1, right? So every trade the customer makes goes to the real market. But that also means that every trade that the customer makes has a real spread cost, has a real execution, and all of these things. So there would be tons of money that, yeah, the broker would not be making. And because also the statistics are that most customers in the retail space, trader 1, 2, 3, 1,000, 1 million, they all mainly lose. That's why the broker is collecting that money. And that's their business model. Now, in return, what you get for a broker that has a B-book is you get better execution. Because that execution is more or less synthetic, right? You can have much faster execution of your trades. You have lower spreads, less slippages, all of these things. When everything is operated on an A-book model, you have a lot more issues like more execution costs, wider spreads, sometimes slippages depending on the, when you trade around news or anything like that. Also, the broker usually offers really, really tight spreads, like 0.1 on a euro dollar or something like that. And the market and the prime of primes here, the LPs, they cannot necessarily give that for huge size. So if you need to trade 100 million on the market, you're not going to get a 0.1 spread. So that's why the broker's job is to juggle. It's literally managing what is coming in and what needs to be hedged out, and make sure that more is coming in and losing than what we need to hedge on the other side of things. And there's tons of, also by now, sophisticated quantitative software that helps them doing that. And because the brokers also operate, let's just say, synthetic liquidity. Some traders out there try to take advantage of it by trading, fast execution arbitrages or things of that nature. I can touch on that in some other video, but it's important that you understand just that's from the execution side of things. Now, how does the broker actually get those traders, though? That's really important. So what we know now is how the broker makes money. The broker makes money by the losses of their customers and the spreads and commissions that the customers pay, right? Very important that this is how the broker makes money. Actually, let's write this down. Broker earning. Number 1, customer losses. Number 2, customer fees, let's just call them, okay? So this is how they make money. Now, how do they get customers? And this is where it gets interesting, where you also need to understand. Now, brokers spend a ton of money for what? You know, for what? For online marketing. Online marketing. Now, you would say actually, most brokers, when you look at them, they're more or less copycats of each other. Like, tell me really, of the big brokers, how do they differentiate from each other too much? Do they? Because, they all give you, that's something I can also touch on. They all give you like the same leverages, more or less the same spreads, so it's more or less the same. By the way, what brokers do from a regulation standpoint, let's touch on regulation for a second before we go to how they get customers. Regulation is usually a broker operates 2 different ones. One is, let's just say, regulated. So that could be in Europe, in UK, in Australia, things like that. Usually regulated means lower leverage. Lower leverage because the regulation is more strict. They don't allow the customers to have higher leverages. And they also have then other restrictions about what they can do with the client money and where they need to safekeep it and things of that nature, and reporting requirements and a bunch of things, This is the regulated. Now, a lot of brokers operate several different licenses. So they may have a UK business, but they may also have one in, it says, wait, let me also make a shape here. Let's call this unregulated. And the unregulated ones are, unregulated is a wrong word. It's actually weak regulated, let's just say. Weak regulated. So that could be Mauritius, Seychelles, Vanuatu, any these beautiful islands, So why they do that? Because over there they can offer basically high leverage. So, and you would ask yourself okay, high leverage is great, right? I want to leverage my money when I trade. Now, the statistics are a bit clear here. The higher the leverage, the quicker people lose money. The quicker people over-leverage. The more people take risk. And the sooner they are parted with their money when they're inexperienced, okay? Simple example. You open an account. You deposit $500. And then you want to trade with, let's just say, half a lot. Do you know how much half a lot is? Half a lot is 50,000. So you see, you have only $500 in your account, but you're moving a $50,000 position. You see, so that's a lot more. So every little move on the market is going to have a huge P&L, profit or loss, affecting your account. Also, the spread cost will be based on the big position. So if I open a position that is 20, 30, 50, 100 times as large as my account balance, the spread will be equal to the position size. So brokers make more money with higher leverage, and people lose faster their account balance through higher leverage, okay? That's very important that you understand that why higher leverage is something brokers want you to use. And very often they are not allowed to sell you necessarily. They're offshore, depending on your location. But that's why they do it. And again, look, I'm not trying to trash that in any shape or form. I'm trying to bring knowledge and clarity, understanding. This is how you survive on the market, not just creating strategy and all this database stuff that I talk about all the time, but this is also facts that you need to understand. So getting back to this one here, online marketing. So brokers do online marketing a lot to show, themselves or on sports teams. And also, that's not necessarily online marketing, but they're marketing machines. Brokers are a lot more marketing machines than trading houses. A broker is basically a risk operation and a marketing operation. That is what a broker is. And what they do is they pay people to bring customers. That's the key acquisition model for a broker. This is how a broker brings in customers. And the way they do it is usually through so-called, let me use this here again, zoom a little bit out, through so-called IBs or affiliates. So what are IBs or affiliates? IBs means, or an IB is an introducing broker, and affiliate is basically someone that brings traffic to a broker and customers that open accounts. The point about that is that the brokers don't go out and try to get individual customers themselves. Usually it all goes through these networks. IBs could be educators. IBs could be signal providers. IBs could be all sorts of like people that pretend to give you something else than how they're actually making their money. It could be social media personas. It could be, anyone who brings a customer to a broker can be an IB. Anyone. There's very little requirements to that. And the brokers have actually two models of how they pay these affiliates. There's one, which is a so-called CPA, cost per acquisition. I'll explain in a second what that means. And they have also something called rev share. What is a rev share? So I'll explain that too. So CPA means if they know the affiliate or the IB, they know how much of customers they usually bring, they know that the customers, they also give them rules. So the customer needs to be trading at least 3 lots, depositing $500. So there's metrics that they give the affiliate that the customers of the affiliates need to fulfill. And when they establish a relationship with the IB and the affiliate, that most of their customers actually fulfill that criteria because they need to know what they're making at the back end of every customer that's signing up and depositing, okay? It's a math game. It's actually from online gambling type of business models. It's taken from there. So they pay an affiliate a flat fee. It could be $500, it could be $1,000 even. And this is how brokers actually are much more in competition with each other. They're not in competition here on the trader side of things. They more or less all offer the same spreads and pairs and anything. But what are they paying their affiliates? This is where they often try to, be very competitive with each other. And so they may pay someone $1,000 for every customer that he brings. And obviously, how would they pay that? Because they know, okay, once that trader got in here, we recycle him through whatever we do, we give him our trading education, trading signals, whatever, he will have high leverage and he will just lose. That's like the statistics of things. So this is how they pre-calculate what one lead costs them and pay it upfront to the IB or the affiliates. And then there's another thing. It's called rev share. So essentially, there's also agreements where the affiliate or the IB will get a share of the losses that the customers have generated in their trading. So if the customer loses $1,000, then an affiliate may get 30% of that, $300. It could be having both of these things in place too. So essentially, again, here is a strong conflict of interest. A lot of IBs and affiliates, again, that could be educators, people that sell you their trading courses. That could be signal providers, EAs, anything that gives you a link to open with a broker has this incentive model. And depending on their agreement with the broker, they will make money on you signing up and depositing and trading, creating volume. That's why they give you signals. And like, a few years ago, that free signal scheme was very big on social media. You know, you see all these people with Lamborghinis, and they tell like, hey, I give you my signals for free. All you got to do is open an account with broker XYZ and deposit $500, and then I'll send you my signals for free. And people would flock into that in the hundreds of thousands, and they would do that. And there's still like countries where this happens. Just in Europe and UK, that's pretty much saturated by now, or also not as allowed anymore because the regulators got too many complaints. But then these people get the signals. The signals are apparently rubbish, garbage. There always are. And people just end up losing. And this is how they all make money. And then as they lose, they even get a rev share. And now even think about, there's even brokers that have copy trading. So there might be even an IB affiliate can also be a copy trading operator. Someone that tells you, come and invest in my trading strategy. And then they will do something like a martingale strategy that looks fantastic on the chart. For some time, it will make fantastic profits. And it will just continue to go up and up and up and up and up and up and up. What these strategies do is that once they are losing, they add to losers. They add to losers as much as they can. At some point, the margin call comes, or they could close all positions in a little profit. And there's even brokers and copy trading platforms that don't even show the equity to their customers. You only see the closed trades, not the open trades. By now, that's also been a lot more known. But what it means is that you would not even see the losses of a copy trading operator. But the losses that the copy trading operator generates, basically when the customers lose through the trades of the copy trader, he makes money off the losses of the trading volume and for the key people signing up. You see? So it's really important that you understand, if you follow someone for their copy trading, understand what platform are they operating on. Are they getting kickbacks and rev shares? Are they getting CPAs? Are they getting volume-based fees? That's a third one here, volume-based fees. Let's just say volume-based. So what is volume-based? It's basically for every trade that you make, you pay spread and fees and whatever, and they get a share of that. There's also, again, copy trading platforms that charge you also a copy fee. And that copy fee, regardless of the size of your account, there's one platform, I think they charge about, $1 or €1 for every trade, whether your account is 100,000 or just $100. So you're paying 1% on a small account, basically, just for copying a trade from someone that would make money even if he causes you to lose. Plus not even seeing that he's causing losses on his copy trading in the first place. So, look, I'm not saying everyone in this game is out there to scam you, but it gives a lot of opportunities for scammers to navigate within that, okay? And if you don't know anything about it, you would just have that IB or affiliate. You see a guy successful, pretending he's a great trader, doing, webinars, seminars, giving signals, any of these things. But essentially, he's making money from the broker. And the broker income model is from customers' losses and customers' fees. And those losses and fees are distributed to the IBs and affiliates. Again, those could be educators, signal providers, EAs, copy trading, so many different things. Anyone that brings a customer, they have they pay these earnings in form of volume-based fees, CPAs, and rev shares, meaning a share of the losses to the affiliates. This is how the brokerage, monetary setup works like. And that's also why the broker doesn't send all customer trades to the market, because they wouldn't have the money to pay these people that money if every trade went to the market. So this whole thing is somewhat of a casino operation. And again, it's not about saying all of that is bad per se, but don't fall victim to IBs and affiliates that tell you that they are so great in trading, because 99.9% of them are not. And most, they all make money this way rather than from their actual trading. And if you don't understand that, you will, learn it the hard way. So please don't let yourself, be blindsided by the Lambos, the watches, the whatever. This is how they make money. Plus, they sell you courses and stuff on top as well. They make some extra money there. So that video was to bring you education about how this jungle actually looks like. If you liked it, please share with anyone that actually trades. I'd love that this information be out there just for people to better understand what they're getting themselves into. Nonetheless, if you can be very successful in trading, you can go from zero to a millionaire, and you can, I'll talk about prop firms in some other video, you can access third-party capital, you can scale yourself up, you can work from anywhere in the world, you can have a freedom lifestyle, but you gotta first learn how to trade, build your own trading strategy, be able to do it, a solid one based on a statistical edge that works for you, all of these things that I talk about time and time again. And then this is the way of how you build yourself into a successful, independent life based on trading. Thank you very much for watching, and see you in the next video. Bye-bye.